Hello everyone, this is Nick Perry of Schaeffer's Investment Research with your chart slideshow for Wednesday, December 27th. Today I am here with the first part of what I hope to be a series on option basics. The topic of options can be rather complex, and a 5-minute description is what I'm shooting for. In that time, you're not going to cover everything there is to know about options. So what I want to do is basically sort of touch on the basics of what a call option is, and then run through the example of an aggressive buying strategy to sort of show you how that plays out. And then hopefully in future slideshows, I can come back and demonstrate other strategies that you can do with calls, so that at the end you kind of have a understanding of the application as opposed to just the theory. So the textbook definition of a call option is that it is a contract that gives you the right but not the obligation to purchase shares of the underlying stock. In most situations, one option contract is going to equal 100 shares of the underlying stock. So for example, to calculate the price of the option, you'll see it quoted, say $1.50. You have to multiply that by 100 to get the actual what you would actually pay for that option. So for a $1.50 option, you would actually have to spend $150. Now, if you're like me, the textbook explanation doesn't really do a whole lot for me. So what I have to do is basically, in my head, sort of go through an example to sort of solidify things. So what I've done here is created just a generic example, and we'll kind of walk through it to show the possible outcomes and what basically goes on with an option buying situation. So in this example, we've got XYZ company, and we'll say it's trading at $50. If you're looking for the stock to rally, in this case we're talking about a rally to 57, which is roughly 14%, and you're expecting that to happen by February, one of the uses for options is that you could buy a call option and try to profit from that. So in this case, you'd possibly be looking to buy the February 55 call. And depending on the volatility of the stock, the option is going to vary. I just pulled one example from one stock that I was looking at for a stock trading near 50 to look at a 55 call, and it was trading right around 50 cents. So, this is one example of what you'd actually be looking at. So in this scenario, basically you're saying, okay, you expect the stock to rally, you expect it to happen by February, so you're going to buy the February 55 call, and this gives you the right to buy the stock at $55 a share anytime up until expiration. So in this example, suppose you do purchase this option. Now let's talk about what are the possible outcomes that you might experience. Probably the one you need to focus on the most is what happens if the stock finishes below 55. The stock was trading at 50, which means you did not see a gain to 55. Any close below 55 at expiration means your option is going to expire worthless, and you will lose your entire investment in that option. Even if the stock finishes at 55, the call option is still going to expire worthless. And the reason is it gives you the right to buy the stock at 55, and that gives you no added value because you can already buy it at 55 in the market. Where you get a payoff is when the stock finishes above 55. And to figure out the intrinsic value of your option, what it's going to be worth on expiration, it's basically whatever the current price is minus 55. Now, for those curious where the stock price minus 55 comes into play, let's just go through a quick example. Let's suppose that at February expiration, the stock closes at 57. In this case, your call option is worth $2, and again, that's your 57 minus the 55. You bought this option for 50 cents. You can now sell it for $2, and so that gives you a profit of $1.50, which is a 300% gain. And again, we talked about a 14% move in the stock that yields a 300% gain. So in the slide before, a couple slides ago, we talked about any move below 55 or even a close at 55, and you lose all your money. And that may lead people to say, well, why would you ever buy an option? Well, this is the case. It's leverage. An aggressive option, if you're right, if you get the right option, if you pick the right time, you can leverage gains in a stock that you normally see in a stock to pretty hefty gains on an option. Now, I need to stress the idea that this is a very aggressive example. If you listen to what I just said, I said if this, if that. You have to get everything right in a situation like this, because you need, if the move takes a month longer than you expected, maybe it happens in March, too bad. You had a February option that expired. So that sort of illustrates the aggressive side. That's where you get your biggest leverage, but it's also the biggest risk. And in the options world, in the market, the trade-off is usually risk for reward. The more you take on of one, the more you're trying to get of the other. So in this case, we have a very aggressive example, but that's by no means the only way you can use options. When you're just talking about the buying of options, you can go what's called in the money, and these options have intrinsic value. They have a higher cost. Instead of the 50 cents we were talking about, you may be spending $5, $6, $7, $8, maybe even up to $20, depending on how far in the money you go. You can also buy options with longer expirations. If you're not sure if the move is going to happen by February, there might be a situation where there's longer term options. You may have heard leaps. Basically, these are options that go out a year or more and give you the time to ride this out. Again, you'll pay more for these options, which will decrease your leverage, but you're basically hopefully decreasing your risk that you're going to completely lose all of your money immediately on the trade. And you can basically take combinations of in the money with longer expiration dates, to sort of tailor combinations. And again, this is just talking about the option buying side. There's things you can do on the selling side, and there's definitely more complex strategies, but that's a little bit beyond the scope of what I wanted to cover today. Today, basically, I just wanted to sort of go over the basics of it, run through a quick aggressive example, and sort of leave it at that. And in future chart slideshows, I will sort of go over these more complex strategies. But for now, I'm going to leave it with that.